Welcome back. You're with us on Trading Hour, and it is time to get a corporate conversation going. And we're discussing banking and a couple of the recent developments with respect to system-wide liquidity, as well as what the RBI minutes are saying. Now, the minutes of the last meeting of the Reserve Bank of India's Monetary Policy Committee showed that the RBI seems quite determined to keep liquidity tight and prepared to look through the first round of food inflation increase that we've seen. To discuss this and more, we have Pralay Mondal, MD and CEO of CSB Bank, now joining in. Mr. Mondal, thank you very much for joining in. We also want to talk about, how gold loans are shaping up because gold prices have come down. But, more on that in just a bit. First, this whole issue of liquidity deficit, which obviously got triggered with this incremental CRR that the RBI decided to put forth. Now, has this impacted you in any way? And also the expectation that rates are going to stay higher for longer here in India, the rise in bond yields, is all that sort of impacting the way you're seeing your cost of funds shape up?
Good morning, Survi, and good morning to your viewers. Now, a very relevant topic in today's discussion, because today is the Fed meeting and the announcement on the conversation which will happen in the Jackson Hole as well, and that will have an impact globally as well as in India. As you rightly said, that the temporary CRR increase was actually aimed towards sucking out some of the liquidity from the system. And we have been in and out in terms of liquidity. It has gone into negative territory as well, and it's marginally around between 50,000 to 30,000 in that range. So to that extent, I think the banking ecosystem has been a little bit kind of challenged on the liquidity side in the last few weeks or so. Whether it will sustain or not, and what is the kind of cost of funds or the deposit rates going up, and the deposit accretion will happen, to some extent also depends on what RBI wants, and to some extent what the Fed announcement today is. So overall, is it raising the little bit of a deposit rates in the system? Answer is yes. And as you know, that the bond yields has been moving between 7.2 to 7.24. And if you see the US bond yield also has gone up again. Yesterday, dollar index again had crossed 104. As we're talking, it is around that range. And hence, all of that do have an impact on the rates in the system. So as we talk, yes, the rates are slightly elevated, and liquidity is a little bit of a challenge in the ecosystem. How it will move from here? We have to see what RBI's decision will be, whether they will, do it on a limited period, or they will have a extension to this. It depends on that. So we as a bank are ready for everything. For us, liquidity is not yet a challenge because we are a smaller part of the overall ecosystem, and we have our liquidity in place. Our deposits are growing pretty well. As you know, the last quarter we grew by 21% on the deposits. This quarter is also going pretty well. And our asset growth has also been at least 50% faster than the system so far. And hence, last quarter it grew by 30%. This quarter also we are going pretty well. So overall, I think for us, our size of the bank, we are able to manage the whole thing pretty well. So that's broadly on that front. On the gold, as you rightly said, that gold loan prices has been going down a little bit globally. It's directly impacted with the dollar index to some extent. When it touches 104, it will have some impact, and that has happened. However, there is a kind of a balancing factor in terms of the rupee depreciation as well. So overall, I think rupee depreciation normalized for the gold loan prices globally has brought down by 8 to 10% in the gold loan prices in the last few months. But does it impact really on the gold loan business? Answer is not yet, because we have a LTV somewhere around 75%. So an RBI norm is for non-agri gold loan around 75%. So we have enough room on that front. So we are not seeing any major challenges on that front as yet.
Okay. I'll come back to your expectations of the gold loan growth. But before that, wanted to understand a little bit about the possibility of a rising credit risk in the unsecured retail loan portfolio of the industry. For you, your retail book is just growing. I think in the quarter gone by, the overall retail loan book was about 3,000 crore, but it compares with 1,000 crore in the comparable quarter of last year. So it's still relatively very small. But can you break that up in terms of secured and unsecured? Which one is growing faster? And is there a credit risk associated with the unsecured portion of the book for you? And if you have any thoughts for the industry, anything that you've picked up?
Rima, I will cover the industry first because that's more relevant for the whole ecosystem, and then I'll cover quickly ours because ours unsecured portion is extremely low. The industry, obviously, I don't think there are any systemic risks as such, but there has been caution which has been also given by various messages which has come from RBI in the last few quarters or so, including in the meeting where RBI governor himself had addressed the board of directors of the bank, where he mentioned that banks need to look at the unsecured portfolio carefully. And when you talk to some of the credit bureaus like TransUnion or Experian and all these people, you do see a slight uptick on the elevation, especially on certain portfolios, smaller tickets, unsecured, and also some of the self-employed kind of unsecured, etc., which people call business loans, small business loans. So some very early indicators of early mortality or 30 plus delinquency and those kind of things are being seen. But does it have a very large systemic impact? Clear answer is no, because those days we have seen in 2008, 2009, we are not seeing that kind of a scenario at this point of time. Does it impact some specific credit? I was reading the other day somewhere that a lot of this digital kind of penetration is happening into the tier 2, tier 3 cities, etc. And we need to understand whether the credit education is happening in these markets, and do they understand what they're taking, what kind of loans they're getting into, and how does it impact their credit scores and things like that. So there is some kind of a discussion happening on that. But broadly at a systemic level, I don't think there is too much of a stress as yet, but people need to watch it. Coming closer to our bank, our unsecured portion, both on the SME side, the business loan side, as well as on the personal loan side, and we have very limited small credit card portfolio, which we do through partnerships, is extremely small. So it will not be material for us. And having the experience, I've run these businesses before, we are extremely cautious and careful what we're doing. So it is really not that relevant for us at this stage.
Okay. We'll leave it at that. Thank you very much, Mr. Mondal, for joining in. Need to slip into a break. We'll come back with more on the markets.